I'm George Soros. I've been investing for over 70 years and I'm worth about $7 billion. People are always asking me for the secret to building massive wealth. They want to know the complex strategies, the sophisticated theories, the insider knowledge that allowed me to accumulate billions. They expect some elaborate formula that only the ultra wealthy understand. But the truth is much simpler than that. Everything I've achieved, every billion I've made, every market I've conquered, every crisis I've profited from Midas comes down to just five fundamental rules. Five simple principles that anyone can understand, but almost no one is willing to follow. These aren't the rules they teach you in business school. They're not the conventional wisdom you hear from financial advisors. In fact, most of these rules directly contradict everything you've been told about how to make money. But they work. They've worked for me for 7 decades, and they've created more wealth than most people can imagine. When I broke the Bank of England in 1992 and made $1 billion in a single day, I was following these rules. When I navigated the dot-com crash and came out ahead while others lost everything, I was following these rules. When I positioned against the housing bubble and profited while millions lost their homes, I was following these rules. These five principles have guided every major decision of my career. They've allowed me to spot opportunities that others miss, avoid disasters that destroy other investors, and compound wealth at rates that seem impossible to most people. They're the difference between getting rich and staying rich, between making money and building generational wealth. But here's what I've learned after applying these rules for decades. Knowing them and following them are completely different things. Most people, when they hear these rules, will nod their heads and think they make sense. But when the moment comes to actually apply them, minus when money is on the line, when emotions are running high, when everyone around them is doing the opposite, they'll abandon these principles and follow the crowd instead. That's why so few people ever build real wealth, even when they have access to the same information, the same opportunities, and the same markets that I do. It's not about intelligence or education or connections. It's about having the discipline to follow these five rules, even when it's uncomfortable, even when you're criticized, even when you doubt yourself. Today, I'm going to share these rules with you exactly as I've lived them, not theory, not academic concepts, but the actual principles that turned the refugee with nothing into one of the world's wealthiest investors. The question isn't whether these rules work. My track record proves they do. The question is whether you have the courage to follow them when it matters most. Because I'll warn you now, these rules will challenge everything you think you know about money, investing, and wealth building. They'll make you uncomfortable. They'll put you at odds with conventional wisdom and popular opinion. But if you can follow them consistently, they'll change your financial life forever. Rule number one, it's not about being right. It's about making money when you're right. This is the rule that separates amateur investors from professionals, and it's the foundation of everything else I'm going to tell you. Most people think investing is about being right as often as possible. They want to pick winners, avoid losers, and have a high success rate, but that's completely backwards. I've been wrong about plenty of investments over the years. I've made mistakes, missed opportunities, and lost money on positions I was convinced would work. But I'm still worth $7 billion because I learned early that being right doesn't matter nearly as much as how much you make when you're right and how much you lose when you're wrong. Let me explain this with a concrete example from my own experience. In 1992, when I decided to bet against the British pound, I wasn't certain that I was right. There was a significant chance that the Bank of England could defend the currency, that the government could change course, that I could lose everything I had put at risk. But I structured the trade so that if I was right, I could make enormous amounts of money, potentially billions. And if I was wrong, I would lose a manageable amount that wouldn't destroy me or my fund. This is what I call asymmetric risk-reward, unlimited upside, limited downside. When the pound collapsed and Britain was forced to leave the European exchange rate mechanism, I made over $1 billion in a single day. Not because I was certain I was right, but because I had positioned myself to make massive amounts of money if I was right, while limiting my losses if I was wrong. This principle applies to every aspect of wealth building, not just currency speculation. When you're looking at any investment opportunity, don't ask yourself, will this definitely work? Ask yourself, if this works, how much can I make? If it doesn't work, how much will I lose? And what's the probability of each outcome? Most people do the opposite. They make small bets on things they're pretty sure will work, limiting their upside while still exposing themselves to meaningful downside if they're wrong. They might be right 70% of the time, but the 30% of the time they're wrong wipes out all the gains from the times they were right. The asymmetric approach means you can be wrong more often than you're right and still build enormous wealth. If you make bets where you can lose $1 but make $10, you only need to be right 15% of the time to break even. If you're right 30% of the time, you're making massive returns. This is why I focus on situations where consensus opinion might be wrong and the potential payoff is enormous. During the 1997 Asian financial crisis, most investors believed that the Asian currencies and markets were fundamentally strong. I believed they were vulnerable to speculative attack and positioned accordingly. The risk was that I was wrong about the vulnerability, in which case I would lose my initial investment. But the potential reward was that I was right, in which case I could profit enormously as currencies collapsed and markets crashed. The asymmetry was compelling, limited downside, massive upside. When the crisis unfolded, my positions generated billions in profits because I had structured them to capitalize on maximum downside scenarios. I wasn't trying to be right about every detail of how the crisis would unfold. I was positioning to make enormous amounts of money if a crisis occurred while limiting my losses if it didn't. This principle also means you have to be comfortable with being wrong frequently. If you're making asymmetric bets, you're often betting against consensus opinion, which means you'll be wrong whenever the consensus is correct. But the times you're right will more than compensate for the times you're wrong. Most people can't psychologically handle this approach because it requires accepting that you lose money on most of your high upside bets. They want to be right all the time, so they make conservative bets that limit both their upside and their downside. But limiting your upside is the surest way to stay poor. The key insight is that wealth is built through asymmetric opportunities, not through consistently correct predictions. You need to constantly scan for situations where you can risk a small amount to potentially make a large amount. These opportunities are rare, but when they appear, you need to act decisively and size your bets appropriately. Rule number 2, understand that perception shapes reality. This is my theory of reflexivity, and it's probably the most important intellectual framework I've developed over my career. Most people think that the markets simply reflect the underlying economic reality, that stock prices go up when companies perform well and down when they perform poorly, but that's only half the story. The other half is that market movements themselves influence the underlying realities they're supposed to reflect. When stock prices rise, companies can raise capital more easily, invest in growth, attract better employees, and actually become more valuable. When stock prices fall, companies face funding difficulties, lose talent, and actually become less valuable. This creates feedback loops where perception and reality influence each other in ways that can push both far from what traditional analysis would suggest is rational or sustainable. Understanding these reflexive dynamics has been the key to my most profitable investments and my most successful market timing. Let me give you a specific example of how this works. During the dot-com bubble of the late 1990s, internet company stock prices started rising based on legitimate optimism about the potential of the internet. But as prices rose, those higher prices made it easier for internet companies to raise capital, hire talent, and invest in growth. The availability of capital and talent actually made many internet companies more valuable than they would have been otherwise, which justified higher stock prices, which attracted more capital and talent, which made them even more valuable. This reflexive feedback loop pushed both stock prices and company fundamentals far beyond what either would have reached independently. The key insight for investors is recognizing when these reflexive processes are at work and positioning accordingly. During the early stages of a reflexive boom, when the feedback loops are just starting to work, enormous profits can be made by positioning with the trend. But during the later stages, when the reflexive process has pushed prices and fundamentals to unsustainable levels, enormous profits can be made by positioning against the trend. I used this framework during the 1992 currency crisis with the British pound. The Bank of England was trying to maintain an artificially high exchange rate through the European exchange rate mechanism, but maintaining this rate required high interest rates, which were damaging the British economy, which made the high exchange rate less sustainable, which required even higher interest rates. This reflexive process created a situation where the very act of defending the currency made it more vulnerable to attack. The Bank of England was trapped in a feedback loop where their defense mechanisms were actually weakening their position. I recognized this dynamic and positioned accordingly, betting heavily against the pound. When the reflexive process reached its breaking point and the Bank of England was forced to abandon the fixed rate, the pound collapsed and I made over $1 billion. This wasn't just about predicting that the pound was overvalued. It was about understanding the reflexive dynamics that made the bank's position unsustainable. The same principle applies to bubbles and crashes across all markets. Bubbles occur when reflexive feedback loops push prices far above fundamental values. Crashes occur when those feedback loops reverse and push prices far below fundamental values. The key to profiting from both is understanding when reflexive processes are at work and how they're likely to evolve. During the housing bubble of the 2000s, rising house prices made homeowners feel wealthier, which encouraged more spending and borrowing, which stimulated the economy, which supported employment and incomes, which supported higher house prices. This reflexive loop continued until house prices became so disconnected from incomes that the process became unsustainable. I positioned against the housing market not just because houses were overvalued, but because I understood that the reflexive processes supporting the bubble were becoming increasingly unstable. When the feedback loops reversed, house prices didn't just fall to fair value and they overshot to the downside as reflexive processes worked in reverse. Understanding reflexivity also helps with risk management because it shows you that market movements can become self-reinforcing in ways that push far beyond what fundamental analysis alone would suggest. This means you need to be prepared for more extreme outcomes than traditional models predict. The practical application is that you should always ask yourself, how might market movements themselves influence the underlying fundamentals? Are there reflexive processes at work that could amplify movements in either direction? And how can I position to benefit from these reflexive dynamics rather than being destroyed by them? Rule number 3, I'm only rich because I know when I'm wrong. This might be the most counterintuitive rule of all, but it's absolutely crucial for building lasting wealth. Most people think that successful investors are right all the time, that they have some special ability to predict the future with accuracy. But I've learned that the opposite is true. The most successful investors are the ones who recognize their mistakes quickly and cut their losses before they become catastrophic. I've said publicly many times that I'm only rich because I know when I'm wrong. This isn't false modesty, it's the literal truth. My ability to admit mistakes, change my mind, and exit losing positions quickly has saved me from the kind of devastating losses that destroy most investors. Let me tell you about one of my biggest mistakes and how handling it properly actually made me money. In the early 2000s, I was convinced that the technology bubble had ended and that technology stocks would continue falling for years. I maintained large short positions in technology companies long after the market had bottomed. As technology stocks began recovering, I initially dismissed the recovery as a temporary bounce in a longer bear market. But as the evidence mounted that I was wrong, the technology companies were actually improving their fundamentals and their stocks were reflecting real value. I had to make a choice, admit I was wrong and reverse my positions, or stick to my original thesis and risk massive losses. Most investors in this situation hold on to losing positions because admitting error feels like failure. They convince themselves that the market will eventually prove them right, that they just need to be patient. But I've learned that this kind of stubbornness is the fastest way to destroy wealth. So I admitted I was wrong. I covered my short positions, taking significant losses, but then I went further. I actually reversed my position and bought technology stocks because the same analysis that told me I was wrong about the short side told me there were opportunities on the long side. This reversal from being wrong about technology stocks falling to being right about technology stocks rising ended up being enormously profitable. If I had stuck to my original thesis and refused to admit I was wrong, those losses would have compounded and potentially destroyed my fund. The key insight is that being wrong isn't the problem, staying wrong is the problem. Every investor makes mistakes, but wealthy investors cut their losses quickly while poor investors hold on to losing positions hoping they'll recover. This principle applies to much more than just individual stock positions. It applies to entire investment strategies, economic predictions, and life decisions. When the evidence shows that your thesis is wrong, you have to have the intellectual honesty and emotional courage to admit it and change course. During the 1980s, I was convinced that the US economy was headed for a prolonged period of decline and that international investments, particularly in Europe and Japan, would significantly outperform American investments. I positioned my fund accordingly with heavy allocations to international markets. But as the 1980s progressed, it became clear that the American economy was actually entering a period of extraordinary growth and that US markets were outperforming international markets by wide margins. Many fund managers in my situation would have stubbornly stuck to their original thesis, convincing themselves that American outperformance was temporary. Instead, I admitted I was wrong about the relative prospects of different markets and shifted my allocations accordingly. This flexibility allowed my fund to participate in one of the greatest bull markets in American history rather than missing it due to ideological stubbornness. The practical application of this rule requires developing what I call intellectual humility. You have to genuinely believe that you might be wrong about any investment, any prediction, any strategy, and you have to create systematic processes for evaluating when you're wrong and acting on that recognition. I maintain detailed records of my investment thesis, including specific criteria for what would make me change my mind. If a stock I'm shorting rises by more than 20%, I review my thesis. If economic data contradicts my macro predictions for 3 consecutive months, I reconsider my positioning. These systematic approaches prevent ego from overriding analysis. The psychological challenge is that admitting you're wrong feels like failure, especially when money is involved. But I've reframed this in my mind. Admitting you're wrong when you're wrong isn't failure. its intelligence. Staying wrong when the evidence shows you're wrong is failure. This rule also means you have to be comfortable with uncertainty and changing your mind frequently. Most people want to form opinions and stick to them because it feels more confident and decisive. But markets are constantly evolving, and the best investment approach often requires constant adaptation to new information. The wealthy understand that changing your mind based on new evidence is a strength, not a weakness. The poor think that changing your mind is inconsistency or lack of conviction. This fundamental difference in mindset explains why some people build wealth while others don't, even when they start with the same opportunities. Rule number 4. Think in systems, not events. This rule has become increasingly important as I've gained experience, and it's what separates short-term traders from long-term wealth builders. Most people focus on individual events, a company's earnings report, a central bank's interest rate decision, a political election outcome. But wealthy people understand that events are symptoms of underlying systems, and the real money is made by understanding and positioning for systemic changes. When I analyze any investment opportunity, I'm not just looking at the immediate factors affecting that investment. I'm looking at the broader systems, political, economic, social, technological, that will shape the environment in which that investment operates over years or decades. Let me explain this with the example of my most famous trade, the 1992 bet against the British pound. Most people saw this as a currency speculation based on the technical mechanics of the European exchange rate mechanism, but I saw it as a bet on the fundamental incompatibility between different economic systems. The deeper systemic issue was that Britain was trying to maintain a fixed exchange rate with Germany while running different monetary and fiscal policies. The German economy was dealing with the inflationary pressures of reunification and needed high interest rates. The British economy was in recession and needed low interest rates. This systemic incompatibility made a fixed exchange rate unsustainable. It wasn't about any single economic indicator or policy decision. It was about the mathematical impossibility of maintaining inconsistent policies indefinitely. The system would eventually force a resolution, and that resolution would involve the pound falling dramatically. Understanding systems also means understanding feedback loops, unintended consequences, and second-order effects that most people miss. When I positioned against Asian currencies in 1997, I wasn't just betting that individual currencies were overvalued. I was betting that the entire Asian development model was systemically unstable. Asian countries had been borrowing heavily in dollars to finance domestic growth, creating a mismatch between foreign currency liabilities and domestic currency assets. Thus, as long as their currencies remained stable and their economies grew faster than their debt service costs, this system worked, but it created systemic vulnerability to any shock that might affect currency stability or economic growth. Once speculative pressure began on one Asian currency, the systemic interconnections meant that pressure would spread to other currencies, creating a domino effect that would be much more severe than the sum of individual country problems. Understanding these systemic relationships allowed me to position for a regional crisis rather than just individual country difficulties. The same systemic thinking applies to long-term wealth building strategies. Instead of trying to pick the individual winning stocks, I focus on understanding which systems are likely to create or destroy value over long periods, which industries are likely to grow or decline based on demographic, technological, and regulatory trends, which countries are likely to prosper or struggle based on their institutional structures and policy frameworks. For example, I've been bullish on technology investments. not because I can predict which specific technology companies will succeed, but because I understand that technological advancement is a systemic force that will continue creating value for decades. The specific winners will change, but the system of technological innovation and adoption will continue generating opportunities. Similarly, I've been cautious about certain traditional industries, not because I have strong opinions about individual companies, but because I see systemic forces, automation, globalization, changing consumer preferences that are likely to create headwinds for entire sectors. Systemic thinking also means understanding how different systems interact with each other. Political systems affect economic systems, which affect financial systems, which affect individual investment opportunities. Changes in one system create ripple effects throughout other systems, often in ways that aren't immediately obvious. During the 2008 financial crisis, most people focused on the immediate causes, subprime mortgages, bank failures, credit market freezes. But the systemic issue was that the entire global financial system had become over-leveraged and interconnected in ways that created systemic risk. I positioned defensively, not because I could predict exactly how the crisis would unfold, but because I understood that the system was unstable and that any shock could create cascading failures throughout the interconnected financial system. This systemic understanding helped me avoid the massive losses that destroyed other investors who were focused only on immediate events. The practical application is that you should always ask yourself, what systems are at work here? How do these systems interact with each other? What are the feedback loops and second-order effects? And how can I position to benefit from systemic changes rather than just reacting to individual events? This requires developing a much longer time horizon than most investors use and being willing to make investments that might not pay off for years, but position you to benefit from inevitable systemic changes. It's more challenging than event-driven investing, but it's how real wealth is built over decades rather than quarters. Rule number 5, position against extremes, not trends. This final rule ties together everything else and represents the culmination of my investment philosophy. Most people try to identify trends and follow them, buying what's going up and selling what's going down. But I've learned that the real money is made by positioning against extreme, buying when everyone is selling and selling when everyone is buying. This isn't just about being contrarian for the sake of being different. It's about understanding that extremes in market sentiment and positioning create asymmetric opportunities where the risk-reward ratios become compelling enough to justify large positions. When I talk about extremes, I mean situations where market sentiment has become so one-sided that almost everyone believes the same thing about the future direction of an asset, a market, or an economy. These extremes create several characteristics that sophisticated investors can exploit. First, extremes in sentiment usually coincide with extremes in positioning. When everyone believes that something will continue going up, everyone who can buy has already bought. This means there are fewer incremental buyers left to push prices higher, but plenty of potential sellers if sentiment changes. Second, extremes in sentiment usually coincide with extremes in valuation. When everyone is optimistic about an asset, they are willing to pay premium prices for it. When everyone is pessimistic, assets often trade below their intrinsic value because no one wants to own them. Third, extremes in sentiment create their own instability through reflexive processes. When everyone believes the same thing, small changes in evidence or sentiment can trigger large changes in positioning as everyone tries to exit or enter at the same time. Let me give you a specific example of how I've used this principle. During the late 1990s technology bubble, it wasn't enough to recognize that technology stocks were overvalued. Many stocks are overvalued without creating profitable short-selling opportunities. What made technology stocks attractive short candidates was the extreme nature of the sentiment surrounding them. By 1999 and early 2000, the sentiment around technology stocks had reached levels that were historically unprecedented. Everyone believed that the internet would revolutionize every aspect of business and that technology stocks would continue rising indefinitely. Traditional valuation metrics were dismissed as irrelevant to the new economy. This extreme sentiment created several opportunities. First, many technology stocks were trading at valuations that required perfect execution and unlimited growth to justify any disappointment would cause massive price declines. Second, everyone who wanted to own technology stocks already owned them, so there was limited buying pressure to support further price increases. Third, many investors were so over-concentrated in technology that any decline would force selling to meet liquidity needs or risk management requirements. When technology stocks began declining in early 2000, the same reflexive processes that had pushed them to extreme highs worked in reverse to push them to extreme lows. Investors who had been competing to buy at any price became desperate to sell at any price. The key insight is that extremes don't last forever, and when they reverse, they often reverse violently and completely. This creates asymmetric opportunities for investors who can identify extremes and position accordingly while managing the timing risk of being early. I use several indicators to identify extremes in sentiment and positioning. Media coverage is one indicator. When financial magazines are putting the same investment theme on their covers repeatedly, when dinner party conversations revolve around the same investment opportunity, when taxi drivers are giving advice about the same asset class, these are signs that sentiment may have reached extreme levels. Institutional positioning data is another indicator. When hedge funds, mutual funds, and other institutional investors are all positioned the same way, when cash levels are at historic lows or highs, when leverage ratios are at extremes, these suggest that positioning may have reached unsustainable levels. Valuation metrics relative to historical ranges can also indicate extremes, though these must be interpreted carefully because structural changes can alter appropriate valuation ranges. But when assets are trading at valuations that are multiple standard deviations away from historical norms, they may be approaching extremes that create opportunities for contrarian positioning. The psychological challenge of positioning against extremes is that you're often buying things that everyone hates and selling things that everyone loves. This feels wrong because human nature makes us want to follow the crowd and do what feels safe. But extremes exist precisely because they feel so compelling to most people. If buying at the bottom felt good, it wouldn't be the bottom. If selling at the top felt wrong, it wouldn't be the top. The opportunities exist because positioning against extremes requires going against every psychological instinct that most people have. The practical application is that you should constantly scan for situations where sentiment, positioning, and valuations have reached extreme levels in either direction. These situations don't occur frequently, but when they do, they offer some of the best risk-adjusted return opportunities in all of investing. When you identify these extremes, you need to position with the appropriate size and time frame, understanding that extremes can persist longer than seems rational and that timing the reversal is difficult. But if you can develop the patience and discipline to position against extremes while managing the associated risks, this approach can generate extraordinary returns over time. Bringing it all together, these 5 rules was focusing on asymmetric risk reward, understanding reflexivity, and knowing when you're wrong, thinking systemically, and positioning against extreme minus form a complete framework for building substantial wealth through investing. They're simple to understand but difficult to implement because they require going against natural human instincts and social pressure. The combination of these rules has allowed me to compound wealth at extraordinary rates for 7 decades, while avoiding the catastrophic losses that destroy most investors. They've worked in every market environment I've encountered, and I believe they'll continue working for anyone who has the discipline to follow them consistently. But remember, knowing these rules and following them are completely different things. When money is at stake, when emotions are running high, when everyone around you is doing something different, it takes tremendous discipline to stick to these principles. That discipline, more than intelligence or education or connections, is what separates those who build lasting wealth from those who don't. The choice is yours. You can follow the conventional wisdom and get conventional results, or you can follow these rules and potentially achieve extraordinary results. But understand that following these rules means accepting responsibility for your own financial future and having the courage to think and act independently, even when it's uncomfortable. After 7 decades of applying these principles, I can tell you that the discomfort is temporary, but the wealth they create can last for generations.